Sam Burns, Chief Strategist at Mill Street Research, is here, and we're talking about his quantitative approach to picking stocks now in the Money Life Market Call. Yes, it's Market Call time, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly in the market today, and how they put it all together. And making his maiden voyage in the Market Call today, somebody who I think you're going to be really interested in because of the approach that he uses. Sam Burns is Chief Strategist at Mill Street Research, which is an independent research company that basically has developed its own institutional research tools for asset allocation and stock selection and macroeconomic measures and indicators. And truthfully, he does a lot of work not only with stocks, but with ETFs. Now, we're going to drill down on stocks today while talking a little bit about the macro side and some of the ETFs as well. But if you want to learn more about how it all works, you're going to go to millstreetresearch.com. Sam Burns, welcome to Money Life.
Hi, Chuck. Thanks for having me on.
We always start with methodology, and like I said, yours, quantitative, but that means a lot of things. Institutional, that means a few things too, and using ETFs and stocks. So you got to tell us how it works.
Sure. No, happy to. And yeah, you're right. I deal with a lot of institutions and research here, but that can be a wide range of types of firms. It could be big mutual fund companies or very small investment advisors with only 2 or 3 people in them. So it's a pretty wide range of type of clients that I work with. But they're all kind of have a day job of looking at the markets and trying to find good investments, as opposed to the individual investors who maybe are working with a wealth advisor or something like that. So that's kind of the tilt that I have and what a lot of the indicators are constructed for, but they're applicable for pretty much anything. So yeah, so there's asset allocation and stock selection. A lot of it has a kind of an objective quantitative tilt to it.
But that said, the macro level, like which comes first, the macro or the micro? Are we top down to then go bottom up, or are we bottom up and then we layer over top down?
Well, that's right. And actually, a lot of what I do is sort of both. I have a lot of top-down indicators that I use more for asset allocation, kind of big picture, risk on, risk off, that kind of thing, and as well as sentiment and economic data. And then I kind of merge that with what I find kind of bottom up, looking at individual company indicators on earnings, price, and valuation, and then aggregating those up to industry or sector or even country level, and to see where the sort of headwinds and tailwinds, as I call them, are for the fundamentals as well as the prices and valuations. So earnings estimate trends are kind of the key bottom-up factor that I look at, and on the macro side, it's more price trend and kind of cross-asset influences from fixed income and commodities on equities.
Well, we have a market that has been relatively range-bound. Maybe in the last week or two, it's kind of broken out of that range a little bit, but not a lot. And it has been a market that has been driven by just a few stocks. So when you put that into your models, what is it telling you in terms of where the opportunity is?
That's right. So I've been bullish on equities in general for a while now and still am. Most of the indicators are pretty well lined up, and the recent improvement in all the major indexes certainly helps that. It kind of gives it sort of more of that momentum that you like to see after having a long stretch of either down last year or consolidation this year. So typically this is a pretty good scenario overall for the equity market. And you're right, it's been led by a lot of the large caps and technology stocks in particular. So it's been relatively narrow. We're starting to see that improve somewhat recently, just in the last couple of weeks. Some of the smaller and mid-cap stocks doing better now. So my guess is that there will be signs of improvement for the average stock, kind of the broad base of stocks, kind of catching up a little bit with where the tech stock leadership has been. And a lot of that is based on the improvement in the earnings picture that I'm seeing.
So you're seeing improved earnings. Are you seeing improved growth in an economy where we see recession, at least in the offing? Like, is this a value-driven market or is this a growth-driven market?
I think it's very much been a growth-driven market this year after being very value-driven last year. And I think that the recession call that a lot of people were actually making 6 months ago and hasn't happened is probably going to be pushed out even further. I'm looking for slower growth, but not necessarily a recession. And I think the economy's been holding up a lot better than people have expected. And I think it will continue to do so, even though the Fed has been doing a lot of tightening and raising rates. Fiscal policy is a key factor for why the economy's been holding up a lot better than people expected. And that's coming through in earnings that we're hearing from companies and seeing analysts raise their earnings forecasts, which is not typically what you would see if you were about to go into a recession right away. You're also seeing strength in things like industrials as well as technology, a lot of consumer stocks. Those are the areas that you wouldn't see showing relative strength if you thought you were going immediately into a recession. So a lot of the work I see both bottom up and top down in the economic data is better than expected. It's not spectacular, but it's better than expected. And that's really what the market focuses on, is whether it's better than expected. And expectations were pretty low coming into this year, and now they're starting to get revised higher, and the market's responding accordingly.
So are you leaning more heavily to ETFs to buy sectors, or are you leaning more heavily at individual stocks because this market isn't supporting the broad go buy a sector or a widely focused fund where you've got a lot of names in it?
Picking individual stocks gives you a lot more flexibility in terms of being able to find the relative strength even within a sector or within an industry. So that's tended to be what I focus on, and a lot of what my clients look at. But certainly there have been some sectors like large cap technology that have done well, and that you could buy pretty much the whole sector. But a lot of those are very concentrated in a few stocks. So you think you're buying an ETF, which is broadly diversified, but in many cases, particularly at the sector level, it's not really. It's really only 4 or 5 stocks that are driving the whole thing. I try to look at that as one of the risks of some of the narrowly focused ETFs, particularly the cap-weighted ones, and try to look to stocks where I can, because a lot of sectors are very diverse and have a lot of different things going on. There's areas of strength and areas of weakness, and so if you can kind of isolate those, you can often get better results.
Now, as I understand your work at Mill Street Research, ultimately you are ranking stocks. You're taking a look at what is out there. You're running them through your system. You are coming up with a ranking. People are familiar with star systems and everything else, but what is your ranking system so that when you're telling us you like this particular company, how do we know this is the score that they're looking for that gets them at the top of your charts and this is the one that keeps them off of your charts?
And that really is the core, is having some sort of an objective process for stock selection. And in my case, this tool that I've built about 10 years ago that I call MARE, it's an acronym for the Monitor of Analyst Earnings Revisions. And that kind of tells you that the key driver of it is the direction or the change, the revisions to earnings estimates by analysts, in aggregate. So I'm looking for when they've been cutting estimates for a stock and now are starting to raise them to get more positive on a stock, or in reverse, if they've been raising estimates for a long time and are now starting to cut their estimates, that tells you things are deteriorating and you probably want to be cautious about that kind of stock. So ideally, I'm looking for stocks that have strong, broad-based analyst upward revisions. So it's not necessarily what the level of their earnings forecast is, it's which direction they've moved most recently, because that's really where the incremental information comes from on the fundamental basis. So I call that kind of fundamental momentum. And then I also look to see if there's the price of the stock is corroborating. If you get price momentum to go along with the fundamental momentum, that's extra good. And then you also look to see, well, is the valuation really extreme or not? Is there a really high PE ratio or something on this stock where maybe all the good news is already priced in? So ideally, you'd like to find a stock that has strong earnings estimates, they're rising, good price momentum, the stock's been outperforming, say, over the last 6 months, and the valuation is reasonable, so it's not all already priced into the stock. If you can meet those 3 things, then it's going to score well in my work. And then the reverse would be the stocks that fall to the bottom of the list, stocks that have negative revisions, that have poor price performance, and are expensive. And that's how I do it on a consistent basis and can look at sectors and industries as well as individual stocks that way.
How long or how long term are your rankings? In other words, I'm not going to ask you for your favorite stock because you're a quant. When I always joke, I love asking quant guys about their favorite stock because the right answer for a quant is, I don't have one, but my computer tells me I like this. But I'm about to ask you for the poster children for the methodology. However, how long do they stay there? We are now in a world where data is king. You can change the data almost every day, but how often do you wind up finding things get from the high rankings where you're buying them to now they've moved? And is it rapid, or because it's based on earnings revisions? Yeah, it's not much more than a couple of quarters or whatever. It takes a little time.
The trends in these kind of factors that I'm looking at tend to be, in the order of anywhere from 1 to 6 months. So they won't change necessarily every day. The data does update every day, but a stock that's highly ranked today will be probably highly ranked next month. And generally that can go on for a number of months. And sometimes you'll find stocks that will stay highly ranked and have strong earnings estimate revisions and upside surprises for months and months and years at a time. But that's not typical. So I would say kind of 3 to 6 months is the typical kind of time horizon for a stock to really stay near the top of the list. It may still be a decent stock for longer than that, but just to really have everything lined up at the top of the list That'll usually be, kind of a 3 to 6 month horizon typically.
Quickly, Sam, I want to ask a question that's just because I've highlighted the fact that you do institutional research. My audience is not made up of institutions. This research is appropriate for them. Is there anything that you would say, hey, if you're an individual and you hear us talking about stuff that's right for institutions, don't think of this for yourself because you're not your own institution?
Well, I say that just because, yes, the work is designed for people who are more actively managing a portfolio. There might be some of your listeners who are actively managing their own portfolio as an individual investor. They can certainly get ideas from the work I do. And I do publish a weekly report called the Weekly Roundup that's also available on the website, which gives stock ideas based on the same process that I'm describing to you that the institutions get. And it will give my market view, 20 stock ideas to buy potentially and 20 to avoid, as well as some macro commentary. It's kind of a slice of what I do for institutions. And so that can definitely be applicable to individual investors who are kind of watching their portfolio a little more actively and want some ideas of what to do with it. So they can use it as well.
The audience is probably pining at this point to find out what stocks you like, or more importantly, what stocks Mayor, your model, likes. So what's the poster child or a few poster children for the methodology?
Sure, yeah. And so when I look at the top of the list right now, whether it's the S&P 500 or even the broader universe of stocks, there are some themes that show up. And a lot of them are related to basically people going out, travel, entertainment, air travel, hotels, all those kind of industries are showing up pretty strongly in my work. The other theme is kind of home building, construction, all that kind of stuff that related to either residential housing or infrastructure. Those are all also showing a lot of strength. And then to some degree, technology, particularly software companies, are also relatively strong. So as an example, I'm seeing several airlines are at the top of the list. American Airlines, United Airlines, Delta Airlines are all right at the top of the list within the S&P 500. They're seeing both lower fuel prices and demand for people to go places. And we're also seeing things like Booking Holdings that does a lot of the Priceline, things like that, where people book their travel. That's one of the top ranked names. And then Royal Caribbean, as an example, a cruise ship line is right there at the top of the rankings. So there's several of those up there that are all related to kind of travel, entertainment, people going out and doing things, which of course they couldn't do for so long after COVID. We're also seeing things like home builders. Lennar is one of the top ranked. Pulte Group is up there. Some of the home builders that people often don't expect to see there because mortgage rates are still pretty high. And people assume that the housing market is going to be weak. But they've actually seen a lot of relative strength, both in terms of price performance and their earnings estimates rising. So there's still demand for residential housing. I'll be much more cautious about commercial real estate, but residential housing is also a theme there. And then, a stock like Salesforce or something like that that's in the software industry is showing up pretty well, as well as some of the other areas that have been strong. A lot of the big cap tech names, Akamai is another one that's near the top of the list. Some of those have valuation concerns. They've had a big run. They're not as cheap as people would like, but they do have strong earnings estimate trends. And so that's kind of the major factor that gets them to the top of the list typically.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Shall we play a game?
Well, the game is our lightning round here on Money Life, and the electronic voice, well, that's like a quantitative approach, which is what my guest takes. Sam Burns is Chief Strategist at Mill Street Research. If you want to learn more, millstreetresearch.com is the website. And, of course, Quick and Dirty is where we put our guests to your test. Send your name, your hometown, the ticker symbols you're interested in to Chuck at moneylifeshow.com. We're going to start with a request we got from Dale in London, Ohio. He wants to know about PFLT, that's Pennant Park Floating Rate Capital.
So it's one of the stocks that shows up near the top of the list. It's not widely followed by analysts, but it has been seeing its earnings estimates go up. It's exposed to some of the lower grade debt, I guess, that's got higher yields now. And so they're starting to see their earnings forecasts for that go up.
That's enough to put it onto the buy list. That's a buy on PFLT, Pennant Park Floating Rate Capital. Ellen in Harbor Springs, Michigan wants to know about GSK, GlaxoSmithKline.
This is one of the large cap pharma stocks, and it's one of the few areas that's actually strong in my work within the healthcare sector. A lot of the healthcare stocks are relatively weak right now, but GSK is relatively strong. It's been having a lot of very strong earnings estimate revisions. Analysts have been raising numbers pretty consistently for the last 6 months or so. The stock has not really outperformed that much, because we've been in this kind of environment where the high beta stocks have gotten a lot more attention, but it's gotten a lot cheaper than it was. It's down at a very low multiple now. So both the combination of earnings estimates going up and the multiple being low is really supporting this stock right now, GSK.
That's a buy on GlaxoSmithKline, GSK.
Come on, let's buy.
Richard in Chula Vista, California wants to know about Stone Company Limited, STNE.
STNE is another one of the ones that shows up near the top of the list here. It's had revisions turn up again probably the last 6 to 8 months. The stock has started to outperform. It's doing better on a risk-adjusted basis. And it, too, has seen its relative PE multiple come down. So it's trading at roughly the market multiple now, whereas in past years it had been a much more expensive stock. So you got it cheaper. You got the analysts starting to get a lot more positive, and the stock is starting to outperform this year after a big underperformance from 2021 through 2022. So we like to see that. An upturn after a big decline is often an opportunity for stocks like this.
We are looking at that upturn, and that's a buy on STNE, StoneCo Limited.
It's hit rock bottom. Come on, let's buy.
Greg in Short Hills, New Jersey wants to know about Dycom Industries, ticker DY.
So this is one that's had more positive activity in the last few months. The relative performance has been sort of mixed. Doesn't have a lot of analysts that cover it, but they're pretty broad agreement that estimates are getting better. And they've jumped quite a bit in the last month or two, which is a good sign. We like to see when analysts are not only raising estimates, but raising them more decisively, making really big moves in their estimates that something has really changed. And that's what we've seen here. And this is a good example of one of the kind of construction, engineering related infrastructure type companies that's doing better now than they had been previously. And it's part of an overall theme that's part of the kind of building and construction idea that we see in a lot of the stocks that are highly ranked right now.
We're 4 for 4. That is a buy on Dycom Industries, ticker DY.
Let's make some money.
And we finish today with a request from John in Seattle, who wants to know about TG Therapeutics, TGTX.
So this is another healthcare stock, biotech company. These can be a little tricky because in many cases, companies like this in biotech, many of them do not have positive earnings. They're losing money. So in this case, this is an example of one where the earnings forecasts are for negative earnings, but they have been getting less negative. So the analysts are getting incrementally more positive, starting to think that there's a path to profitability here. The stock's had a big run and has pulled back a bit, which is another thing that I look for is the stocks that have been doing well over the last, say, 6 to 12 months, but have given you a pullback to enter. Buying a dip within an uptrend is one of the things we look for in terms of price action within the Mayer ranking model. So if we see analysts starting to raise estimates and the stock pulling back after a good run, that's often an opportunity, chance to get in, even for a company like this one, where the analysts are forecasting losses for the next year or two.
So that's a buy on TGTX, TG Therapeutics.
Buy! Is that all you can think about?
Yes, buys are all we have thought about during Quick and Dirty today, and we've got one more good buy to talk about. That's where we say our goodbye to Sam Burns. But Sam, this was a blast. I hope you'll come back and do this with me again sometime.
Oh, it'd be a pleasure. Thanks for having me on.
That's Sam Burns, the Chief Strategist at Mill Street Research. It's millstreetresearch.com. If you want to get more information on Twitter, it's at MillSTResearch. And we will be back to tell you where Sam agreed or disagreed with some recent guests, let you know what's coming tomorrow, and more as we cross the finish line right after this message.